this conference. Ladies and gentlemen, it's a privilege and honor to be here. Privilege and honor to be a part of a momentous occasion when the Chamber is completing 90 years of its journey. When the video was being shown from 1924, 26 onwards, what's happening, there were a number of luminaries that were shown to say they were associated with the organization, they were in some form or the other having contributed to the organization. And it feels extremely proud and a privilege for us also to say that somewhere down the line, we are also associated with some people of that nature, giving us the inspiration that we need to move to their caliber, their standards, and continuously therefore strive the way we go about, strive for reaching those laurels concerned. There is a Chinese saying which says that if you want to go fast, go alone. If you want to go far, go together. This 90 years is an extreme, wonderful example of people staying together and growing together, and that's why a huge amount of distance has been achieved. Not just that we have reached somewhere and then dropped out. Sustainability can happen only when we are all together. I was also looking at the aspect that 180 people here, if we join together, assemble our thoughts, put our ideas on any topic, any matter, there is no way in which we can be held back. It's going to be a huge distance we can together cover. Therefore, these are primary occasions, these RRCs, where we are all joining together. And a paper writer like me is only an excuse for the purpose of gathering further the knowledge so that we all join together for the purpose of taking this knowledge forward. It's with that objective in mind that, yes, I said yes to this paper. I found that it was a difficult task to write. Then I had somebody in our office also, again, to get the combination works. There are a number of people from our office who have helped me, and I have called them here today. Mr. Shivanand and Vibhuti are the two prime people who have done this job. There are two others whose contributions are not insignificant. Very significant contributions also from Nitin, who is my nephew incidentally, and also Prem. They have worked ceaselessly for this purpose. And if you found something today that's worthwhile, it's because their contribution, putting together thought process, looking at so much of knowledge bank, seeing that it flows very well, a huge amount of efforts have been happening from them, for which I am taking the credit. Actually, I am only a representative of all of this group concerned. And that's again a good example of how working together can take things forward. Sri Ravi Shankar was making a mention, slightly out of the context, that, yeah, 3 C's are important. Context, compassion, and commitment. I was looking at this real estate industry and looking at us as tax practitioners. I've made a statement that this is a topic of 4 T's: title, transaction, transfer, and taxation aspect. This was a matter or a subject I had dealt with a senior chartered accountant in Bangalore, who was a specialist in immovable properties. He has devoted his life to immovable properties and taxation, and was able to think very well. So when I was talking to him, he made a mention, look here, Padam, all this is fine, conceptually fine. Look at how do we convert this into practice. And he says, the practice in real estate industry is a matter of 6 C's. So I'll carry forward the legacy of C that Pujya Sri Ravi Shankar made a mention of us. He says, when you're going to an assessment, what happens? What is the attitude? What are the 6 C's that are relevant in the practice that is happening? He said, first C is to convince the tax officer. First C is convince. Okay, you put forth the argument very well, he's able to understand, fine, you're able to convince him, you're able to get through what you want to achieve. Not able to convince him, second is confuse. Confuse him. You can't confuse him, not able to do that. Third C is confront him. Confront him and say that, no, this is not the way it will happen. This is the way it happened. I'll take the matter up in litigation, I'll challenge, I'll want to win an appeal and all that. You're not able to succeed. He says the fourth C is carry on and on. Go on prolonging this advocate. It's like a case of a person who was caught by a king and said, tell me what you can do, I'm going to execute you now. Tell me what you want to say on this matter. He says, king, give me time. I'll make your horse fly. And somebody asked him, how can you make the horse fly? The king granted the motive. He said, how can you make the horse fly? He said, I'm sure I can't fly, but let me try it. Let me carry on, prolong this battle concern. I don't know, someday the horse may also fly. I don't know about that. It may fly. The fifth C is what demonetization was trying to curb out. And nothing happened in all of this. The sixth and the last C is to cooperate. To cooperate. Let us have the issue and let us come to an end to the entire battle. The aspect of real estate was discussed. I knew the paper was pretty long, so I told the group leaders, focus on certain areas that are important. It's not possible for us to deal with all of these aspects in detail. So kindly focus on certain aspects that you think are relevant. And in the course of the briefing session, there were certain questions raised by them. And when I was analyzing these questions, it did appear that there are some questions that concern the basics of the foundational aspects of this law relating to real estate. Primarily because we require some sort of a multidisciplinary approach to understand these issues concerned. One. Two, it's a very classic case of over-regulation. There are too many provisions in the law dealing with some sort of allied topics, some sort of topics which have some linkage together, but there is some sort of an imprecision in the deployment of the various terms across the statute. As a result of which, we are not able to stay tuned, stay aligned with the concept. We start looking at one concept, we don't know what's happening elsewhere. Something else aligned, akin is used there, similar is used there. When you go to that concept, there's another third concept that is again similar to it. And at the end of the day, therefore, we are not able to get some sort of a clarity, some sort of a conviction that we need to gather as tax professionals when advising the clients. On basic elementary aspects itself, one does find that the law is not consistent. Take the aspect of the law relating to real estate transactions. The real estate has a number of subsects to it. The most element is the aspect of land, just land. The word land is used in so many places across the Act. Take the example of 47, which talks about a land being sold of a SIG company, capital gains arising therefrom, not being charged with tax till a particular event arises or till a particular situation will arise in the hands of that SIG company. Reference is only to land, nothing else. Go to building. You may have section 32, which tells you you are entitled to depreciation on building. So we have only a reference to building. I'm only giving solitary instances. There are multiple instances. For example, on land, you have the reference to land in section 2, section 33A, section 43B, 80IBA, 194I, 155, 281. These are all sections that deal only with land. I'm just giving you solitary instances as under section 47. We have therefore a reference to the word building being used in section 32. We also have the reference to the word building in 194I. Then we have a reference to land or building. So, there is land, only building. Next is land or building. Which are the sections that deal with land or building? Section 35 deals with land or building. Then you have land or building or both. Classic example is 45(5)(a) now, which talks about land or building or both. We have a case of land or building or both or a part thereof. So therefore we have a part thereof also. So there are some issues in relation to what we mean by land or a building or a part thereof. We have therefore an aspect where land or building or a part thereof is used. For example, in section 194 LA, 269 UA, we use that. Then you have land or building or any rights in land or building. Beyond that, you have the usage of the term immovable property itself. Just the reference to immovable property without saying anything more. For example, 247 will talk about clause 5 and clause 6 will talk about any part performance in relation to immovable property or what is normally termed as GPA in relation to immovable property. So when you have these terms, when you look at immovable property, you try to juxtapose that with land or buildings or rights therein, or just land or building or both. We don't know the exact contour of what we are trying to be grappling with. So there is some element of confusion for us as to, we may understand a particular context, we may understand a particular subject. But the most important point for us to therefore understand and remember is that context, that understanding cannot be automatically be extended to other situations concerned. Because believe me, the terminology is not going to be the same. Many places, many sections used different terminologies. So the problem arises in relation to what you mean by the subject matter of the transfer. This is an issue in relation to the aspect of immovable property is concerned. Then you go into the aspect of what transfer is itself. Transfer is defined in different sections. 247 defines transfer. Section 63 defines transfer. Section 63 says transfer includes a settlement, a trust, a covenant, an arrangement, or an agreement. What do you mean by this? It's going to be difficult. 269 UAF defines transfer. Transfer defined differently. Within 247, we have many terms used. We have the conversion as a transfer. We have the treatment as a transfer. We have the disposing as a transfer. We have the parting as a transfer. We have the creating of an interest as a transfer. So now when you use these terms at different points of time, how are you going to extend this understanding to other places where you're trying to have some sort of a gain associated with a transaction in immovable property? How is it that we understand transfer could become an area of difficulty for us? Therefore, we have some problems in understanding as to what transfer means in those contexts. Then transfer in relation to whom is another context. Transfer by an owner is one. Transfer by a person who has held the asset is another. Transfer by a person to whom the asset belongs to is another concept. So whom are we talking about? Who is the subject matter of the assessment under the Act? Is it the belonging to person? Is it the holder of an asset concern? Is it the owner of an asset concern? What is the difference between an owner and a holder and a belonging to? Could be an area of difficulty for us. Then we have an issue that when you have this transfer, law will tell you that the consideration received is the basic point or the starting point for taxation purposes. But there are a number of places, instead of the consideration, they talk about the fair market value. So what do we mean by this fair market value? 222B defines the term fair market value. This is one part of the story. That's the fair market value. Then we obviously have 50C that talks about the fair market value. To say, in relation to 50C, the fair market value shall be so and so. Then you have 50B that talks about the net worth of the undertaking and the value of consideration received by us. You have the aspect of 45.3 and 45.4 having a different terminology, not necessarily what is referred to as in 50C. Then you have the fair market value to be determined by the assessing officer by the valuation officer by a reference to him under 55A of the Income Tax Act or 142 capital A of the Income Tax Act. Therefore, we'll have trouble there to find out what is mean by the fair market value. Then we have contexts like 56, which talks about fair market value on the basis of rules that may be put in place. So we have a fair market value determined on the basis of rules that will be in place. So we don't have a uniform concept of fair market value under the Income Tax Act. And therefore, we are not too sure as to when we talk about fair market value in a context that is not very clearly defined, what should be the exact understanding of the term fair market value when used in relation to transfer and the computation of capital gains. For all of this, therefore, we are also not too sure as to when is the taxable event arising, which is the year of transfer. Very difficult. Because year of transfer is, they are saying fine, when I sell the property to somebody else, that year in which the property is sold. That's the year of transfer. To that extent is okay. But the law is drawing a number of carving outs of this fundamental aspect. Look at 45 itself. Look at 45, 1 capital A, which talks about not the year in which the asset has been destroyed by natural calamity, but the year of transfer shall be, or year of capital gains at least shall be the year in which you receive consideration from the insurance companies. 45.4 tells you it's not the year when the firm is dissolved, the year of transfer. That's the year in which the assets are distributed by the firm concerned, the erstwhile firm, to the partners. That will be the year of transfer in the hands of the partnership firm. Therefore, that will be a different year in terms of 45.4. 45.5 tells you year of transfer may happen 1 year. If you have received the enhanced compensation subsequently, then the year in which the enhanced compensation is received shall be the year in which it is taxable. We don't bother about the year of transfer, we bother about the year of the receipt of consideration. Therefore, we are having another issue to it. 45.5a is now adding to that. To say that, what is the year of transfer? The year of transfer is the year in which the completion certificate is obtained, provided certain fundamental conditions as laid down in 45.5a are satisfied. So this is the conundrum within which we are functioning. And very logical, therefore, that the group did ask certain fundamental questions as to what will happen in particular situations. Now, rather than answering those questions, I'll begin with a counter question. Therefore, let us take a topic and discuss about it to say, in a particular context, our understanding in one section, can it be extended automatically to other sections concerned? Take the aspect of a lease of a property for more than 12 years. It's a very easy way of understanding to say, lease for less than 12 years, we will not bother about it. Take the aspect of a lease for more than 12 years. Does it tantamount to a transfer? You will tell me, section 27, which defines the owner of a property, makes a statement that a person who is the lessee or a tenant of a property and he has a lease in his favor and that lease is for more than 12 years, then the lessee is the owner of the property. Therefore, section 27 tells us that the lessee is the owner of the property for the purpose of section 27. When he is the owner for the purpose of section 27, how does it trouble you if you were to extend this concept to other sections of the Income Tax Act? How should it trouble you at all? It should not trouble you. They will also tell you that 269 UAF, which defines the word transfer, had a reference therein to say that if the lease is for a period of more than 12 years, it is a transfer, and if the apparent consideration was not to the liking of the government concerned, the government could have paid you some compensation and acquired the property. There also, therefore, lease of a transfer for more than 12 years was taken to be a transfer. Therefore, when we have this transfer and two situations concerned, why is it not possible for us to extend this logic to all other situations concerned? This is one part of the story. Take the other part of the story. If I am a person who has acquired the property under a lease agreement under which I am willing to pay rent every month, I have paid a deposit to the person concerned, and if it were to be a transfer in my favor for more than 12 years, say 15 years lease in my favor, am I going to be troubled by 56 to now 10 to say, look here, there is a transfer of property in your favor because you are now said to be the owner of the property concerned, please pay tax under 56 to 10. Are you ready for that proposition? Because what you are paying for a deposit is going to come back to you. There is no consideration because consideration is that which you can use, appropriate and not refund it back to you. What you are paying every month is for the user of the property, not for the transfer of the property. And therefore, fundamentally, this is a transaction where the law were to regard this as a transfer of ownership, technically under section 27 logic. But then are you willing to pay tax under 56 to 10 to say that I am now in receipt of a property for which I have paid no consideration because whatever I have paid is either returnable to me or is it referable to the use of the property. We are now saying no. This is not the way in which this law has to be understood. Therefore, we ourselves are now saying, at least for the purpose of 56 to 10, lease of a property for more than 12 years is not going to be regarded as a transfer. Take another illustration. Explanation 1 to section 32. It says what? It says that where you have a lease of a building in your favor, and you have incurred expenditure towards the improvement or construction, that expenditure on improvement or construction being of a capital nature, then you are going to be regarded as an owner of the property referable to the increase or the additional construction, not in relation to the original lease, not in relation to the original asset. Only in relation to the additional construction done by you, you're going to be regarded as the owner of that property concerned. I'll be giving you depreciation only on that portion of the property. Therefore, explanation 1 to section 32 tells you, irrespective of the duration of lease, I'm not bothered about the duration of lease, 10 years lease, 20 years lease, 50 years lease, you will not be regarded as the owner. You will be regarded as the owner only of that portion on that lease premises referable to the additional construction made by you or an expenditure incurred of a capital nature in relation to that leased property. Therefore, business head is very clear that lease of a property more than 12 years does not make you the owner, therefore you are not entitled to depreciation. And that is going to save us because if you were to say lease of a property makes you the owner for section 32, believe me, you will not be able to take advantage of section 30 and 31 that deals with rent because they say rent paid by you as a tenant, not by you as an owner. You won't get that rent. Rent paid by you as a tenant only is allowable as a deduction. Rent paid by you as an owner, they'll say I will not allow you under section 30. 37 will tell you those expenditures covered by 30 to 36, they'll get governed there, you can't come under the residuary hit. Possibly you may say, no, this is not covered by 30 to 36 because I'm paying the capacity of an owner, not the capacity of a tenant. Therefore, those sections will not cover me, 30 will not cover me, permit me otherwise to bring it under section 37. Possible. There's going to be some element of difficulty, some element of conviction that is required. If you say you're the owner of the building concerned, you will have no actual cost because you have not incurred anything, no depreciation will be allowed to you. So you're going to be deprived of depreciation, you're going to fight your battle strongly for the purpose of allowing the rentals to be granted to you as a deduction. Therefore, if you look at these propositions of law to say that lease could be a transfer for section 27, lease could be a transfer for 269 UAF purposes, does it necessarily mean lease is a transfer for section 32? Lease is a transfer for 56. Our answer is going to be no. That means we ourselves are drawing a dichotomy now to say that this amount of understanding of lease tantamounting to ownership is contextual, is limited in its understanding. That means you can't apply this logic across all sections of the Income Tax Act in an automatic or a seamless manner. You would therefore look at the context, look at the facts and circumstances, look at the purpose of the law, and then give a limited understanding to the term owner. Lease of more than 12 years does not necessarily make you an owner in all situations concerned. Because if lease were to be giving you the ownership the way we are normally understanding, then can you satisfy section 54 requirement to say, I will lease a property for more than 12 years, I am the owner of the property, give the benefit of section 54, I utilize the consideration for the acquisition of the leased property? It's going to be difficult. So we ourselves therefore are contradicting to say that it may not be a transfer for 54, may not be a transfer for 56, may not be a transfer for 32, may be a transfer for 27. We should therefore be held to be limited in its scope. That means our understanding of lease has to be contextual. We can't therefore say, just because we have arrived at one conclusion, this conclusion shall prevail for all other circumstances under the Income Tax Act. This is one part. Take another example. We'll do 2-3 examples and then move on to certain concepts, the actual realities of what the paper is dealing with. I'm referring to certain questions raised in the course of the group discussion, particularly in relation to rights in relation to a property. Largely concerning 247.5, 247.6. They were asking as to what will happen in relation to this type of part performances. What happens that there is only a part performance of the exit performance. Therefore, what will happen? What is the extent of transfer? Will it be a whole transfer? Will it be a part transfer? What will happen? They're also talking about the explanation that has been added to 247. Explanation has been added to say that how the explanation has to be construed. The group did believe that that explanation has to be construed in the context in which the law was inserted into the statute. What was the context? The context was the understanding of 9(1) subclause 1, sublim 1 by Supreme Court in Vodafone's case. And to get over the observation of Supreme Court in Vodafone's case, there was a package of measures introduced adding explanation 5, 6 and 7 to section 9(1), bringing in an explanation to 2 subsection 14 defining capital asset, and 247 also has an explanation. Rightly or wrongly, there is no reference in this explanation to 214 or 247 to say it is limited to our understanding of 9(1), introduction of explanation 5, 6 or 7. There is no limitation of that nature. Somebody wants to read this explanation, rehearse the context, he will be perfectly justified in doing so unless we win the battle through a court process to say that this is to be read as a package and we can't go beyond the package. So you have to understand what 247 explanation that is introduced says and understand that in the context of what the existing provisions of law are. Supreme Court did say in Vodafone's case that there are certain assets that are full by themselves, they are whole by themselves. There is no purpose, there is no possibility of vivisecting those assets into various congeries. All together will constitute a single asset. Therefore, when you transfer an asset, you transfer all the underlying rights also along with it. You transfer all the underlying rights along with it. A shareholder, for example, has a right to vote, has a right to get dividends, has a right of control and management. He has certain rights about it. When he transfers these shares, he is transferring them all by themselves. There is no question of me transferring the right to dividend to somebody else, right to vote to somebody else, right of management control to somebody else. They are all incidents of ownership. They are not existing dehors the share. They are not existing independent of the share. They are a part of the share. Therefore, there is no question of vivisecting that share into various rights concerned. 1. 2. The Supreme Court also made a mention that there could be certain rights that are contractual rights, that are not proprietary rights, that are contractual in nature. Therefore, these contractual rights, which are largely rights in personnel, cannot be called as capital assets. A right in rem that is available to me against the world at large can only be capital assets. Right in personnel cannot be capital assets. Typically, in relation to the rights of management and control, there could be a contractual right given to me by virtue of understanding the shareholders concerned. I have a negative power, I have a veto power, I have a supervening majority, I have so many types of rights. All these rights are contractual in nature. Therefore, they cannot be held to be capital asset by themselves. They are a part of the share. When the share is transferred, you don't transfer these individual rights separately. They go along with a bunch. No. They said this is not the way we would like the law to be understood. Parliament said, therefore they said we would like to bring in certain amendments. And the amendments in their wordings are very, very dangerous. 214 says, capital asset means property of any kind. 214 says, property shall include rights of whatsoever nature, including rights of management or control or any other rights whatsoever. The last portion of 214 explanation is very dangerous. Initial portion talks about right of control and management. That's what they're trying to get over the Vodafone's case. But the last 5 or 6 words, or any other rights whatsoever, is a term or a phrase added which could trouble a lot of us. We'll see certain examples in relation to immovable properties as to the impact of these last words. Go back to 247 to understand the context of the entire law. It says that when we are having these rights, transfer of any rights whatsoever shall be including the disposing of rights, the parting of rights, or of any interest therein, or the asset itself, or creating of any right therein, whether or not such rights are disposed of, parted with, whether they are directly or indirectly achieved, or absolutely or unconditionally, or voluntarily or involuntarily. Last portion is not very important for us. The last portion, flowing upon, dependent upon, and existing, all that is not relevant. What they are looking at is absolutely, unconditionally, direct and indirectly, voluntarily or involuntarily. The aspect of, therefore, you having a choice, you being conscious about what you are transferring is not relevant at all. They have added that by saying whether the transfer of the rights is voluntarily or involuntarily. All the rights are referred to in 214. The transfer thereof, you are trying to effect. You are effecting of that transfer, maybe voluntarily or involuntarily. Normally, you had a situation where transfer should have been conscious. 45 uses the word transfer of a capital asset effected by an SLC. Therefore, there is an element of voluntariness. People are looking at some element of conscious act by